As Jake mentioned, we're going to talk about the reserve changes, which maybe are the bad news for some, although I don't think it's too severe. Some of the insurance changes, which are the good news. Some other changes and lender questionnaires, and we'll leave time for Q&A at the end. Um, Sometimes when we talk about this, people say, "Well, I don't have a Fannie Mae mortgage. I use Wells Fargo, or I'm going to Bank of America for my mortgage, so this shouldn't apply to me or my association." And I just want to share that these the need for approval or become eligible for the mortgages is really something you want to make sure that you have in your association. It can impact new mortgages and refinance mortgages, and in order to get the best rates and the lowest down payment options for communities, all communities should want approval from Fannie Mae for their mortgages, for their projects, is what Fannie Mae calls them, their projects. And so Jake mentioned this, but a lot of communities have found themselves ineligible. His firm really helps them become eligible when needed. There's a link I'm going to share in the chat here. Oops, to check. Some associations don't know if they are eligible or not. And so, sorry, the chat's turned off for this meeting, so I won't share it, but you can Google it. It's just called the Condo Status Finder, and it tells you if your community is approved or not. Jake mentioned there's some, it's not always perfect. There's some inaccuracies with it, but it's something that you may want to look to learn if you are approved, because it is important to be approved. And the reason we're talking about this today is just about a little less than 60 days ago, a new lender letter came from Fannie Mae describing some changes with eligibility, and that's what we're going to get into today. There is you can view the letter again if you want to Google lender letter LL 2026-03. So that's March of 2026. That talks about this. If you want to see all the details, if you want to see the full selling guide, you can go to Fannie Mae's website and look up the single family selling guide. It's almost 1,200 pages of exciting reading. So if you really want some bedtime reading, that would be where you could go for that. But we're going to touch on the highlights today. And one of the bigger ones, or the more attention getting ones, is that in order to be eligible, community association now has to have 15% of its annual budget dedicated to reserve requirements.
Oh, and Matt,
Yeah.
the one thing on so I know like what we've get a lot of questions on is, well, my state statute has this language, my Condo Act has this, oh, my bylaws say this. That really will not be too relevant. Fannie will check that relates to the law in your state, but Fannie and Freddie guidelines relate to what they can provide to the lenders. So Fannie and Freddie are government-backed entities that buy back the loans from the banks. So if it's not at this, we'll discuss some of the new regulations. If it's not at this 15% reserve budget, then they will reject the loans and not buy back from the banks. So even if it is a state statute discrepancy, that will not matter. And I think eventually a lot of states will end up kind of following the Fannie Freddie trend as things kind of align. So just a quick note.
Good point. Yeah, thanks for mentioning that. The effective date for this, so previously it was 10% of the annual budget had to go toward reserves, and now the effective date, or now it's 15%, but the effective date is not right away on this one. They're giving us until January 4th of 2027 to make that requirement. So it is this won't be in effect until the next budget year, but as we sit here in mid-May, budget season is actually right around the corner. And when it comes to reserve planning, I always tell communities to start early. These are long-term plans, and there's no need to wait until the 11th hour to do your reserve analysis. But as you're thinking about your budget for 2027, and some are on a fiscal budget year that will be starting before then, and that budget may already be in effect, and so you may need to look at revising it. But that budget should have 15% of that. We'll talk a little bit about how to calculate that in a moment. But just beware. Most associations, in our experience, we work with thousands and thousands throughout the U.S. Need to be contributing probably more than 15%. We studied all of the condos that we work with throughout the U.S. And on average, right around 10% or so of associations were maybe okay with slightly less than 15%, but a vast majority, 90 plus percent, really need, in order to have good financial health, at least 15% of the budget going towards the reserve requirement. So this shouldn't be a big impact. I think with the Fannie Mae representatives that I've heard speak on this, and most of their communities, most of what they look at is similar to our data, where most are already putting aside 15% or more of the budget for their capital repair and replacement items. So this shouldn't be a real large impact, that 5% shift, but certainly something to be aware of. But whenever we get those types of specific hard numbers that we have to meet, we say, well, how do we calculate that? And so we dive into my engineering brain dives into the little details and the specification here of how to calculate the 15%. So they specify that the percentages, that percentage is determined by dividing the replacement reserve allocation by the homeowner's annual assessment income, excluding some things. And so the exclusions on the calculation can be special assessment income, income allocated to or in reserve accounts, because a lot of times in the overall budget, a portion of the overall budget is going towards reserve. So that portion can be backed out of the denominator in this case. Incidental income not relied on for maintenance operations or capital improvements. So this might be, some places get rental income, parking income, laundry income. This could be some of that incidental income could be backed out. And then amount paid for owners and paid on behalf of owners, essentially. So occasionally you'll have say a cable agreement or internet access utility where the association pays that, but then bills it right back to the owners. Because that's kind of just a pass through, we can exclude that from the annual budget and to reduce the denominator, which then is going to say we can reduce the numerator, which is the reserve contribution or reserve requirement in this case. How to calculate the 15%. So again, this is just some numbers I think that are helpful to look at it in that. So we might say, well, we've got a total budget here of 1.1 million. So you might take that math and say, okay, we need 15% of that. So we need at least 160,000 roughly contributed to the reserves. But actually, if we back out the reserve portion, which is 150 in this case, and the laundry portion, which is 50,000, you'll find that this community would be compliant because they're contributing more than the minimum reserve funding requirement, which is simply the $900,000 portion of the annual revenue times 15%. So because they're contributing 150,000 and the minimum is 135,000, this community would be considered to kind of check that box as far as eligibility on the reserves. John dropped a question and I appreciate that because it's right on track. So I'll jump to that right now. They're going to look at the current budget year. So they're going to they want a copy of your current budget for determining this calculation. They want to make sure that you're currently budgeting it, not what you did last year, not what you're going to do next year, but what you're currently budgeting. And so,
Matt, that's kind of emphasis on like for the July 1st budget year. Probably err on the side of caution and get your budget kind of tidied up before then. Would probably be a suggestion.
Yeah, it's a great point. And we'll take it even further. What if your budget started April 1st, 2026? And you're in that budget year now, you're going to have to be eligible. You're going to have that 15% in this budget year. So if you don't have it in this budget year, you could potentially run into problems come January 4th when this new requirement comes into place. So you may want to even look back, like I said, if it's July, you're planning now, great. If it's something you have to do, you may want to look at retroactively adjusting that budget to make sure you're over this. Now, I hope, and I can assume actually, I know our audience, and I know the folks that attend these webinars are usually the prudent ones and have probably gotten reserve studies and are already contributing much more than this amount. But if you aren't, this would be a good time to correct that so that you don't have issues with resales out in the future. Great point. And thanks for the question, John. And please, pop your questions in, and we got a lot of folks here today, and I'm sure there's a lot of questions. We'll hopefully cover most of them, but like I said, we'll leave time at the end for them as well. There are some other enhanced reserve study rules, I'm calling them, but really just some other things to be aware of if a reserve study is used. So what happens if you don't? And historically it was 10%, now it's 15%. What happens if you don't have that amount in your budget? Well, you can in those cases show a current reserve study to justify that lower amount. And there are, like I said, maybe 10% or fewer of cases where because of the amount of capital items they have, or the responsibilities within the association, or the maybe on the operating side, some of the additional services they provide, where that 15% may actually be more than what's required for the community, and in those cases you can show a reserve study to justify that lower amount. Now, they've looked at a lot of reserve studies over the years, and they said, there's a few things that we want to make sure the reserve study shows. First of all, we don't want to see baseline funding. Baseline funding, we can talk about in a minute, but it's really allowing the reserves to get to zero. It's really not a very conservative, a bit of a risky plan in a reserve study, and they want to make sure that that's not what's being followed when we're looking at that reserve study. They also want to make sure that the reserve study is not very old. So they want it done within the last 3 years, so 36 months, which actually aligns with CAI, Community Associations Institute, which Jake and I are both big supporters of, and our firms are big proponents of and involved with this organization. They have national reserve study standards, actually international reserve study standards. They work all over the world too. And their standard is say 3 years to do a frequency of a reserve study. So it's a common question. And again, back to the states might have different requirements. Some states could say 5 years. Florida says every 10 years you need a structural integrity reserve study. Fannie Mae isn't going to really care about that. They want to make sure that study is 3 years or less because so much can change in that amount of time. So they agree that that's the time frame. And then the other kind of important, very important fact with this reserve study is that the condo must budget for the highest recommended reserve amount in the reserve study. And so we already said the baseline funding is not allowed. And so what other methodologies may be shown in there? And I'm going to take just a few minutes to nerd out a little bit on reserve terminology here. Bear with me, but there's a few terms that are very confusing by their nature, by our nature, and not things that we deal with every day. So there's a term that we like to use, and again, in CAI's explanation of reserve standards, they use this term adequate reserves. And adequate reserves are both a current balance and multi-year funding plan that provide for the timely execution of the items without reliance on additional supplemental funding. So in this graph here, you can see the blue bar in this graph is expenses. The green bars are inflows to the fund, and the balance is this kind of purple line that goes up and down. And would say this is adequate because it allows a balance sufficient to fund all of those projects in the blue bars. Within the adequacy, there are three funding goals that we talk about with reserve funding, and I've got them kind of overlaid on each other on this map. Full funding is the most conservative goal. We've talked about baseline, which is the red line here. That is the least conservative goal. And then threshold is in the middle. So just taking from the top, full funding means attaining and maintaining a reserve balance that is equivalent to 100% of the fully funded balance. The fully funded balance is the sum. Fully funded balance for a community is the sum of the fully funded balances for all the individual pieces that make up that community. So if you have, let's just use a real simple example, a roof that's a $100,000 roof and a 10-year life. The fully funded balance for the roof, halfway through the life in year 5 is $50,000. In year 7, the fully funded balance for that roof is $70,000, and so on. You take that wherever that roof is at that time, plus the painting, plus every other item, the pavement, the elevators, you name it, all of the items added up together, and we get the fully funded balance. And it's kind of like the theoretical amount that if we set aside the appropriate amount to offset the deterioration for each element from day one of that element's placed in service and existence. This is the amount we would have. And it's usually a very conservative amount and results in higher funding levels, much higher funding levels than baseline, and often higher funding levels in the threshold plan. So that's full funding. Baseline is simply targeting zero at some point in the reserve, and you'll see this is every reserve plan cash flow in it has some lower points usually after bigger projects get done. In this case, it's way out in 2052 here, but you see on the graph here it's say I think I can use my little laser pointer here. You can see in this area the baseline funding hit zero in 2052. So this is the most risky, least conservative, but also the lowest contribution, the lowest reserve assessment that's being put in. And so some associations like to see this. In fact, here in Florida, we have a recent change to our structural integrity reserve study law that says that plan must show a baseline funding plan in it. So often now we're showing a baseline plan as well as a threshold plan, and threshold is probably the most common throughout the U.S. to identify. It's kind of the Goldilocks approach. You see, it's kind of in the middle of the two other funding goals. Essentially, the threshold funding just says we're going to keep our reserves above a certain threshold, even in that lowest point. So instead of targeting zero, we're targeting a cushion here in this particular case is like a $300,000 cushion here in consideration of the millions of dollars of work that are coming up right before that. So those are the three methods. Happy to we have I guess other webinars and content where we can dive really fully into how to calculate each of those. But back to the requirements now, that if you see all three of these plans in your reserve study, you have to follow the most conservative one. You have to follow the highest funding allocation in the reserve study. And so if you're here in Florida, what we're showing is just the baseline and the threshold and not the full funding plan, because we don't feel that that's necessarily the best case for a lot of associations. It's the most conservative, but a lot of our associations aren't going to want to fund that high, and we don't want to obligate them to fund that high. So if there's a plan that you're not using, just ask your reserve study provider to strike it out of the study so that Fannie doesn't look at it and say, oh, you should be funding this much higher, more conservative funding plan. Jake, I'm going to turn it over to you to talk a little bit about the insurance changes. So that's kind of the reserve stuff. And those are the things that probably raised the bar a bit. The thinking there is, we want to have, and these are good practices anyway for communities to be having and ensure the health of the community, and having those requirements in place. Fannie Mae feels and lenders feel like that's going to ensure that we're aligning the eligible projects with healthy projects. And so it does raise the bar a little bit. And I think there was some easing of requirements on the insurance side, because Jake, wasn't a lot of the communities that were ineligible because of insurance?
Yeah, exactly. No, that's a great point, Matt. A lot of so looking through the copies of the blacklist or an eligible list, a lot were, I would say, predominantly insurance related, whether it be excess deductible, whether it be inadequate insurance, certain coverages not available in areas. They had been flagged and put on the blacklist. There was a significant amount also related to deferred maintenance, inadequate reserves. Structural integrity was a big one. I think, Matt, you would probably agree. The changes to the lender questionnaires and the Fannie Mae guidelines, a lot of what is being put in there relates to structural integrity and making sure that deferred maintenance is covered, making sure that fully funded reserves are in place. And now I think it's taking it a step further, which you kind of addressed in the reserve section, and really encouraging and pushing boards and owners and managers to get these reserve studies done. And I think that's a key component and something that, as you know, Matt, has been rising and is more and more important, especially in jurisdictions like Florida, coastal areas, to make sure that these things are covered. Because, yeah, bring it back to the backdrop of everything. I think the Surfside collapse kind of it flipped everything on its head. It made lenders extremely cautious. Just this cannot happen again. This 1 in a million event cannot happen again. And doing things like this and making sure that, engineers are getting in there, making sure that we're doing the milestone inspections, doing all this is important. But yeah, the insurance side of things, there has been a little bit of easing. There's been easing there. There's easing on investor limits and rental restrictions to a degree, because I think a lot of the viewers, and Matt, you probably would agree that insurance has been chaotic and a little bit messy over the last couple years. And one of the expressions we use a lot in our industry is, if a butterfly causes a fire in a wildfire in California, or a hurricane occurs in Florida, it is a kind of total effect across the insurance industry, because it's a kind of a game of numbers, and it's a business. And so if there's a large catastrophe, then other people are going to have to pay up on the other premiums. At this point, there has been some changes to Fannie Mae's guidelines, allowing for a little more flexibility, especially as it relates to master policy, and some of the HO6 and unit owner policy requirements. One of the things, just a general piece of guidance, is consult with an insurance agent, and preferably an insurance agent that is an expert in condo insurance, because I know in a lot of our communities, we'll hear from board members, we'll hear from managers. They'll say, well, I know someone in my uncle, he does life insurance. So they try to get them to do condo insurance. It's not, you wouldn't have a brain surgeon conduct an evaluation on your knee. So it's important to kind of look at it that way. Make sure you have a condo insurance agent who is specialized in condos, and to do it that way. So to the changes, as far as master policy coverage sufficiency, the master property insurance policy must now provide coverage equal to at least 100% of the estimated replacement cost value of project improvements, including common elements and residential structures. Important note, the roofs are exempted from this requirement, though they still must be insured under actual cash value. So policies that provide coverage on an actual cash value basis, or that depreciate losses outside of the roof, will not suffice. And associations may document sufficiency through guaranteed or extended replacement cost coverage, but a replacement cost estimate from the insurer, insurance risk appraisal, or a statement from a qualified professionals would be preferred. Also notably, the requirement for inflation guard coverage has been retired. And this is something that will be implemented effective January 1st, 2027. It brings me to another point on the independent appraisal. An independent risk appraisal or professional statement to make a determination on the replacement value is something that is crucial in these cases. It just adds a lot of value to the property, and make sure that you're properly fit for insurance in your condominium. Next slide, Matt.
Yeah, we see that a lot, Jake. Before I flip it, just on the appraisal topic. Here in Florida, there's actually a statute that says all condominiums must conduct an independent insurance appraisal valuation every 3 years, because they want to make sure, the state said this is so important to make sure that we're not underinsuring or overinsuring our property. And then when I talk to folks in other parts of the country, that they have very few communities that ever conduct an appraisal, and it just makes sense, I think, to ensure adequate coverage. And now Fannie's kind of backing that as well as a best practice.
Yeah, absolutely. And then as to the roofs at actual cash value, so an important caution: insurance for a 10-year-old roof at ACV, actual cash value, would mean that if a $200,000 roof suffers a total loss, you could be short $100,000 compared to the replacement cost coverage if the roof has a 20-year useful life. So just important to kind of note that. We generally recommend replacement cost value. So that's an important kind of piece to keep in mind.
Yeah, I think the thinking here, right, is that if we have reserves for the other portion of the roof that's aged and we're setting that aside, that there's less risk there. And before this was a flag that said if there was ever it was a ACV, actual cash value, it wasn't eligible.
Yep, absolutely. Yes, next slide. Some other master policy coverage requirements. The policy now must include coverage for the following perils: fire, lightning, explosion, windstorm, hail, smoke, aircraft, vehicles, riot, vandalism, sprinkler leakage, sinkhole, volcanic action, falling objects, weight of snow, ice, and sleet, and water damage. Also, just to keep in mind, the master policy deductible maximum, when the policy includes a per occurrence per unit deductible, the deductible maximum is now $50,000. And there's the additional requirement that the borrower obtain an individual unit owner's insurance policy. This is something to keep in mind because lenders are implementing this change for all loans with application dates on or after July 1st, 2026. So this one's pretty imminent, and something to really keep in mind, and get with a insurance agent, discuss with your attorneys, and kind of figure out that that everything lines up with this. There's also another part with unit owner insurance requirements, which are typically the HO6 policies. A unit owner's policy is now required when any portion of the unit's interior is not covered by the master policy, or when the master policy includes a per unit deductible. And the minimum coverage amount for the unit owner's policy must be at least equal to the greater of the cost to restore uncovered portions of the unit, or the per unit deductible amount. And the deductible maximum is 5%, is the greater of 5% of the property insurance coverage amount, or 2,500. And this change is effective immediately as well. Again, these are changes that, if anything, help a little bit. But some stuff to keep in mind and make sure that everything lines up on your end, and make sure that you're checking that everything is good there.
Yeah, these are things that should remove some of the communities that are currently blacklisted from that blacklist. And in fact, the Fannie Mae has indicated that they've kind of looked at the effect of these, and like I said, immediately, if this was what was hanging up a community, making it ineligible, they've tried to remove them from that ineligible list. We'll see if that's all that's kind of TBD when we find out, but that's what we're saying, at least, and that those are good changes that'll make more communities eligible.
Yeah, and I do think just based on all the issues that have been occurring with insurance across the country, these are important changes that hopefully a lot will be removed on these ends. But yeah, to be determined.
Yeah, another thing to be determined is the removal of the limited review process. That's going to make some big changes, Jake, and maybe you can talk about that as well as the smaller communities. I think there was a question about that in the
yeah, absolutely. So the limited review, this is certainly a big change. Definitely is providing for a little bit. This is going to be an area that's going to be more stringent than it was before. Now we're looking at a more full picture of especially the financials involved here. It's a full review process now, which essentially means, and I know, Matt, there was a few bullet points as to what that kind of means, and I think it was deferred maintenance, structural issues, financial stability, things along those lines, reserve adequacy, and maybe some governance records as well, which I know that's in Florida that we've seen as governance records are becoming a large point of contention for multiple reasons. But I don't know if there were some other ones there, Matt.
Yeah. I think you're talking about like the board minutes. Even they're
Mhm.
asking for as a part of those full reviews, and so and they've looked at them and said, if there was maybe a structural issue discussed at the board but no action taken, that can be a red flag. Engineering studies, special assessment discussions. They're really looking for those items to flag a community that may be less healthy, and someone that may want to be, may be looked at as higher risk from the lender's point of view.
Yeah, and I do think there's just a lot more the previous kind of limited review. It's Matt and I were kind of discussing before the session that it was a little unclear what was actually being reviewed. Um, and it seemed like there was less scrutiny, a more streamlined process. We noticed in a lot of, especially the lender questionnaire, sometimes there ideally, if you ended up on the blacklist, sometimes it was a mistake. That's not always the case, so I don't want to get people, that kind of excited that that may be the case. But in some instances, because of the less scrutiny, there wasn't as much of an overall picture. And the reason, so basically, when there's the condo blacklist or the ineligible properties on the blacklist, there's the property name, and then it includes the reason or reasons for being on the blacklist or being ineligible. And those all stem from the lender questionnaires, which basically are fed right into this review process. At this point now, however, the review process is going to be more stringent as it relates, especially to financial rules, and that'll definitely be tightened up as we've seen since kind of Surfside. That has been a trend. For the waiver, you do have a waiver if you're in between 2 to 10 units. For 2 to 4 units, it's a full waiver. You're eligible for a complete waiver of project review requirements under the new guidelines. From 5 to 10 units, there's a conditional waiver where you must meet the budget, insurance, and critical repair requirements to qualify for this waiver. So that's an important exception if you're at 10 units or below to keep in mind. Um, I think the idea here is, the Fannie and Freddie are focused more on the bigger structures, the high rises, the ones that have very large capital projects at play or potentially structural inadequacies that could lead to more devastating consequences. So I think, yeah, the big picture here is it looks like condominium associations, they're being increasingly monitored like a business. Basically, think about it this way: if you're a board member, if you're managing a property, and it's 100 units, every unit is 500,000 or $500,000 per unit. You're managing I think the math is 50 million. But so basically on that, you're managing a property that's or handling and have a fiduciary duty to a property that is 50 million, multi-million dollar project. So it's important that these things are maintained, that things are done properly, that reserve studies are encouraged, and that deferred maintenance is kept in line with the realities that we're seeing in today's market. And that's kind of why we go back to the big picture of this isn't. It could be a perfect buyer, it could be a perfect unit for all we know, but it's the building itself where the financial health is being analyzed. So
Yeah, yeah, and I think it's a big business, and I think it's a heavy responsibility. I always call it the F word that us board members have to wear on our hats. It's that you're fiduciaries, and it's a lot of responsibility. One of the things that I thought was interesting, one of the lenders I heard speak on this indicated that many communities may have never gone through a full review, that they may have always done limited reviews, either the lender itself or the association's always done limited reviews. So this could be a big change for those, and I think it's important just to have a plan for how you're going to get all that information out to the requester, in this case the lender. Um, I also learned that there's a tool that I can share with you called Condo Project Manager that Fannie Mae provides to lenders, And that allows them to kind of check to see if you're eligible, ineligible, or haven't been reviewed yet. And those are kind of the three categories that we look at. I think one of the questions, that just came in is I can't figure out if I'm on the blacklist or not. If you go to a Fannie Mae approved lender, they should be able to look at that condo management tool and tell you that. Jake, any other suggestions for how you would determine if you're on it or not?
Yeah, the tools that are available, I mean, they're not always completely accurate. I know we have if you want to reach out to myself, we do have a list, but it's slightly outdated. It dates back to last July. But yeah, I mean, sometimes you find out the hard way. I'm sure there's people out there that have found out through a seller basically getting rejected, and then hearing about, oh, I'm getting rejected because of this project going on, or I'm getting rejected because of insurance issue. Um, that is sometimes, and then we'll be consulted after that by the board or the manager and have to figure out. And this is a very timely slide, Matt, the lender questionnaire, because everything does start and end with how these are filled out. And again, as I mentioned, I can't emphasize this enough. It could be perfectly adequate between the buyer and seller as to um, being able to finance the project or the unit with that. But then this Form 1076 questionnaire, which you see actually on this slide or on the questionnaire itself, it says addendum added December 2021. Keep in mind, Surfside occurred in June 2021. This was basically a direct result of the amendment, or the addendum is a direct result of Surfside. And if you read through we don't have the full lender questionnaire right here, but it provides for I think they added I think it was 5 pages or 6 pages to begin with. It's now about 12 pages. So 6 pages or 7 pages were added strictly related to structural integrity, strictly related to reserves, and basically just really drilling in on the kind of general welfare and financial health of the condo itself.